Hello and welcome to Decision Critical. By the end of this video, you will be able to work with traded goods in Decision Critical. By definition, a traded good is a physical product that is bought from a supplier and sold to a customer. It may be held in inventory, but it is not manufactured by the business. Let us start by entering this scenario for an existing company called Aftermarket Auto Parts. Perhaps we want to add a new traded product called ceramic brake pad to this scenario. To do this, let us click on Products and then click on Add New Product. As you can see, Decision Critical allows you to add a variety of products and services to your scenarios. You can choose between services, traded goods, manufactured goods, and semi-finished products. In our case, we want to go for traded goods. Let us enter the name of the product, select the unit of measure, set the default sale price and the default purchase price. Let us create this product and proceed to the product card. The left side of the product card clearly displays the unit economics for this product. The system takes the sale price and the purchase price we defined in the previous step and automatically calculates the profit per unit or profit per piece in this case. Next, we can define how we are going to purchase the product. There are two options in Decision Critical: purchase as needed or automatic purchase, and manual. The manual option would require us to input the purchase channel and schedule manually. Here, let us go for purchase as needed. With this option, the system will automatically generate the purchase of the product as needed to fit the demand and support the target inventory levels. An inventory target of 3 months ensures that the system will purchase inventory 3 months ahead of sales. So the system will automatically buy inventory that will be sold in April of a year in January. In other expenses, we can define the product-driven expenses that are associated with these ceramic brake pads. These may include freight in. This expense is incurred on purchase, calculated in Canadian dollars per unit, has a unit cost of $1.28, and comes under the activity group called production. Assigning activity group allocates this expense appropriately in the financial statements. The next product-driven expense is freight out. This is incurred upon shipment, also calculated in Canadian dollars per unit, and belongs to the activity group selling. Lastly, we have import duty, which is incurred on purchase, calculated as a percentage of the purchase price, and belongs to the activity group production. These product-driven expenses are now reflected in the product card. By clicking here, you can see these cost elements visualized as a pie chart. Right, so we are now almost done. The last step is to create demand assumption for these brake pads. Let us assign the default sales channel and select linear demand growth. Linear demand growth means we expect a constant increase in the demand for our product over time. Let us start with a demand of 24,000 units in the first year, followed by a 10% growth each year beyond that. Click Create Demand. Here we can see the yearly demand expectation and the demand for each month as well. If you want, you can manually enter custom values to override the demand automatically generated by the system. Click Update and continue. Once again, we are back on the product card and we can see that our demand assumption is ready and the system has automatically filled the purchase. Now, not only can Decision Critical automatically set your inventory targets, but it can also help you manage your cash flow by setting collection and payment terms. Many profitable businesses have constant cash struggles because of bad cash cycles. The cash conversion period for a business is the sum of the time it takes to move inventory and the collection period from customers minus the payment period to suppliers. To optimize your cash conversion period, it is best to have a short collection period and a long payment period. Let us go to the collection terms and change the settings. You can decide if the money collection for this product happens on delivery, account, or prepayment. Delivery means that this is a cash payment and no credit terms are involved. Prepayment would mean that customers pay us in advance for this product. Let us select on account, which means we will offer some credit terms to our customers and they will pay us 3 months after the delivery. You can do the same with payment terms. Storage rules determine how much physical space this product occupies. Let us assume that we can keep 500 pieces of brake pads in 1 square meter of storage space. The storage rules impact the space requirement for our business. We can see this in the footprint report, which tells us how much space we need versus how much space is available. To export all these product details to a spreadsheet, you simply need to click on the export icon. And that is how you add a new traded good to Decision Critical. We can see it on the product list as well as the updated sales demand graph. Notice that the system has automatically generated the purchase schedule. Since we have an inventory target of 3 months, the system purchases a large amount of inventory at the start of the operations, which then normalizes over time. If you're modeling an existing business, do not forget to set the beginning inventory in the beginning balances section within settings. Click Add Account and select ceramic brake pad. Since we need approximately 2,000 units per month and need 3 months of beginning inventory for an ongoing business, let us enter 6,000 units here. If we go back to our purchase demand graph, we can see that the initial spike has disappeared. And that is all. Thank you for your attention. You now know how to work with traded products in Decision Critical. Happy modeling!